How does a company with $1.9 billion in revenue spend $8.7 billion on hardware in a single year? The answer is a financial loop so perfect it's almost beautiful. In 2024, a company called CoreWeave reported $1.9 billion in revenue. On paper, it looks like a breakout success. But in that same 12-month period, they spent $8.7 billion on hardware. That is a $6.8 billion gap. In any normal industry, that's a bankruptcy filing. In the AI industry, it's called a miracle. But when you look at the serial numbers on those billions, you realize the money isn't actually entering the market. It's moving in a circle. The company selling the chips is the same company buying the stock, which is the same company backstopping the debt. Here's the setup. Microsoft gave OpenAI $13 billion. OpenAI spent most of that on Microsoft's own cloud infrastructure. Wall Street looked at the resulting transactions and called it revenue. nvidia sold chips to a company called CoreWeave, then bought a stake in CoreWeave, then became one of CoreWeave's paying customers. And the whole thing got filed with the SEC as a normal business operation. We're not calling this fraud. That's not what this is. What we're doing is following the paper trail. It may be the same pool of capital cycling between the same handful of companies, each booking the other's spending as their own top line. The case file that makes this visible is CoreWeave, a single S1 filing. One document accidentally mapped the entire loop. So let's start where the money enters the system and trace exactly where it goes. CoreWeave is a cloud computing company. That's the surface description. What it actually is, structurally, is the connective tissue between the biggest players in AI infrastructure. And once you read its S1, you can't unsee it. The first transaction worth understanding is the Microsoft Master Service Agreement, signed in early 2023. Microsoft became CoreWeave's largest customer almost immediately after that deal closed. By 2024, Microsoft accounted for 62% of all CoreWeave revenue, not 62% of one product line, 62% of the entire company's income, $1.2 billion recognized under a single contract with a single counterparty. Now, think about what that means for a minute. If you're an investor looking at CoreWeave's revenue growth, you're essentially looking at Microsoft's willingness to keep writing checks. But here's where it gets harder to dismiss as a one-sided relationship, because Microsoft isn't just buying from CoreWeave. Microsoft is also one of the primary investors in OpenAI, the same OpenAI that is itself one of CoreWeave's biggest compute customers. So the money Microsoft puts into OpenAI flows partially to CoreWeave, which books it as revenue, which makes CoreWeave look like a fast-growing independent business. Follow that loop once, and it's interesting. Follow it twice, and it starts to look structural. The filing spells it out. Microsoft is 62% of the revenue and 66% of the money CoreWeave is owed. Essentially, CoreWeave is just a Microsoft department with a different logo. One relationship is holding the entire company together. But Microsoft isn't the only one holding the leash. This is where nvidia enters, and this is where the loop closes on itself. Therefore, we have to ask, why would the world's most valuable chipmaker need to buy a stake in its own customer? In April 2023, nvidia signed its own master service agreement with CoreWeave. Now, at this point, nvidia was already CoreWeave's primary GPU supplier. Every single GPU in CoreWeave's infrastructure is an nvidia GPU, so nvidia is the vendor. But nvidia is also disclosed in the same filing as a 5% plus beneficial owner of CoreWeave, supplier and shareholder. That's already an unusual combination. But then it goes further. Under the NVIDIA MSA, NVIDIA becomes a paying customer of CoreWeave, purchasing cloud compute capacity from the company it supplies, in which it also holds equity. By the end of 2024, NVIDIA had paid CoreWeave approximately $320 million under that agreement. Mechanically, it works like this. NVIDIA sells the GPUs to CoreWeave. CoreWeave builds the racks. Then, NVIDIA rents those racks back. The money leaves NVIDIA's left pocket to buy the chips, travels through CoreWeave's bank account, and lands right back in NVIDIA's right pocket as revenue. It's a financial U-turn that gets filed with the SEC as a breakout success. That's not revenue. It's a round trip. Now, here's the part that anchors all of this. CoreWeave's 2024 revenue of $1.9 billion looks healthy on the surface, but the investing outflows for that same year hit $8.7 billion. Think about that. They spent $4 for every $1 they earned. Therefore, the business model isn't self-sustaining, it's a debt-fueled furnace. And here's the detail that makes that fragility concrete. 96% of CoreWeave's revenue comes from committed contracts. In the industry, we call this ghost demand. The customers aren't choosing CoreWeave in a competitive marketplace. The spending is locked in by the very people who own the company. Therefore, if the loop breaks, there is no outside market to save them. That's not a product people are buying. That's prearranged consumption inside a closed loop. But here's where the loop becomes a trap. Because nvidia didn't stop at being a supplier and a shareholder. They became the loop's guarantor. On September 15, 2025, nvidia signed an agreement to purchase $6.3 billion worth of cloud computing capacity from CoreWeave. Not chips, not hardware, compute capacity. The thing CoreWeave builds using nvidia's own chips. But buried inside the contract terms was a specific clause. nvidia agreed to absorb any capacity that CoreWeave couldn't sell to other customers. Read that again slowly. The company that manufactures the chips is contractually guaranteeing demand for the infrastructure built entirely from those chips. Therefore, if the market doesn't show up, if Microsoft pulls back or OpenAI scales down, nvidia steps in and pays. They are effectively backstopping their own supply chain with their own capital. This is the structural tell. A backstop agreement is not a normal vendor relationship. It's a guarantee. And in finance, they only get signed when someone is worried the demand might not materialize on its own. Therefore, the infinite demand for AI isn't being proven by the market. It's being manufactured by the supplier. Now let's add the next layer. On January 23, 2026, nvidia made a $2 billion equity investment in CoreWeave. But look at the fine print. The 8K filing that disclosed the investment explicitly tied it to expanding AI capacity using nvidia's own computing platform. Therefore, nvidia is effectively paying $2 billion to help CoreWeave buy more nvidia chips. Chips that nvidia has already agreed to rent back if no one else wants them. Connect the full loop now and it looks like this. nvidia sells GPUs to CoreWeave. CoreWeave rents that compute capacity to Microsoft and OpenAI. Microsoft and OpenAI are themselves deeply entangled with nvidia. Round and round it goes. If this pattern feels familiar, it should. In the late 90s, Lucent Technologies and Nortel Networks both ran what was called vendor financing, lending money to their own customers so those customers could afford to keep buying their equipment. The loans got booked as receivables. The purchases got booked as revenue. Growth looked exceptional right up until the moment demand assumptions broke and the whole structure unwound simultaneously. Lucent's revenue collapsed. Nortel filed for bankruptcy. The customers they had been financing couldn't pay back what they owed because the demand that was supposed to cover those debts never arrived. We're not saying the AI build-out ends the same way. We're saying the mechanism is recognizable, and the SEC is already reading the same filings we are. The 2026 Division of Examinations Priorities explicitly flagged AI representations, customer concentration, and whether disclosed controls match actual business practices. The regulators are not asleep on this. They're just working at regulatory speed. What the loop means when it breaks. So let's bring this back to where we started. How does a company with $1.9 billion in revenue spend $8.7 billion on hardware in a single year? Now you know. It does it by existing inside a loop where the capital keeps cycling, supplier to infrastructure to cloud customer and back, with each pass through the system getting recorded as fresh revenue on someone's income statement. This isn't a conspiracy. Nobody had to sit in a room and plan this. These are rational individual decisions made by companies trying to lock in supply, secure customers, and position for a technology build-out that everyone believes is real. The loop is a byproduct of how those decisions interact when the same players sit on every side of every deal. But here's the fragility that lives inside that system. CoreWeave's entire operating model depends on Microsoft not building enough of its own infrastructure fast enough to replace it. And Microsoft is already doing exactly that. Microsoft's own capital expenditure program is accelerating. Every dollar Microsoft spends building its own compute capacity is a dollar that doesn't need to flow through CoreWeave. That's not speculation. That's disclosed in the same filings that show 62% revenue concentration. If that concentration breaks, not collapses, just softens, CoreWeave's revenue picture changes faster than the debt structure can adjust. And because nvidia backstopped that capacity, nvidia absorbs part of the loss. Because nvidia holds equity in CoreWeave, nvidia's balance sheet takes another hit. Because nvidia is priced as the infrastructure backbone of the entire AI economy, that repricing moves through the whole sector. You don't need fraud for that to be damaging. You just need the demand assumptions to be slightly wrong, sustained for slightly too long. The uncomfortable part is that the information to see this is fully public. The revenue concentration numbers are disclosed. The backstop contract is on the record. The supplier-investor overlap is in the S1. None of this is hidden. It's just presented in the language of normal business filings, which most people aren't reading. So here are 3 things worth checking in any AI company's numbers before you take the revenue growth at face value. First, is more than 50% of revenue coming from a single counterparty who is also a financial partner? Second, is the capital expenditure being funded almost entirely by new debt rather than operating cash flow? Third, does the primary supplier also hold equity in the business? If all 3 are true at once, you're not looking at independent demand. You're looking at a loop. And the question worth sitting with is this: if the loop is generating the growth numbers that are currently priced into these stocks, what exactly happens to those prices the day the loop stops? Nobody in mainstream finance is asking that question loudly, which is usually when it matters most.